Welcome back to another video from Stocks for Teens. In today's video, we're going to be talking about trading. I know I mentioned trading in my previous video, but that was just a very brief explanation about what trading was. But in today's video, we're going to go into the depths of trading and get into a lot of specifics. So be sure to listen and enjoy, hopefully. But before that, I'd like to start off with another quote. This week's quote is, "An investor without investment objectives is like a traveler without destination." I don't know who said this quote, but I think this quote is really important because it just shows that you need to have a plan while entering the stock market. Of course, people take risks every once in a while that isn't according to their plan, but at least they have a plan. And a person without a plan, in my perspective, is like a person heading down a path of destruction in the stock market. So with that in mind, let's get into it. In my last video, I dedicated about 4 or 5 minutes to explain a general overview about what trading is. I provided a textbook definition about trading and provided key differences between trading and investing. But in today's video, we're going to go a bit deeper into understanding what trading actually is, such as where it occurs, why it occurs, and how people trade. But before that, we need to know what's involved while people trade. So these are some terms that are related to that. Just as a recap, trading is not the same as investing. Investing takes a long-term approach to the stock market as you invest in a few stocks but hold them for a long period of time. Trading, on the other hand, involves short-term strategies that you can implement so that you can maximize profits in a short period of time. When you trade, there are multiple aspects that are involved with trading. The most obvious being stocks. There are many different types of stocks that people often don't know about, which is why I've listed 5 of them right here on this slide. We already covered blue chips in a previous video, but blue chip stocks, just as a reminder, are stocks with large market caps. If you don't know what market capitalization is or what large market caps fall under, then be sure to check out my first video. Moving on to the new stuff, growth stocks are the shares you buy for capital growth. You find growth stocks in companies whose earnings grow at an above average rate relative to the stock market. Likewise, yield stocks are stocks that do well in any given situation. They do especially well in the bull markets, but also provide protection in the bear markets. These are for income seekers who steadily rely on cash flows on a daily basis from the stock market. If you don't know what bull or bear markets are, then be sure to keep listening because I'll be covering that in just a few minutes. Moving on, new issues are basically just initial public offerings or IPOs. IPOs are stocks that have been newly released by companies who have just entered the stock market, such as Peet's Coffee and Warner Brothers. Finally, defensive stocks, which are right here, are like yield stocks, but they don't go down as much because they come from the consumer staples sector. Since companies from the consumer staples sector provide essential and valuable goods to their customers, people are willing to keep investing in them, which is why it's categorized as a defensive stock. So, as promised, I'm going to be talking about the bear and the bull markets, which basically record movement in the stock market. When a person mentions the bear market, it's actually trading talk for when the stock market is in a downward trend or is in a period of falling stock prices. On the other hand, the bull market is when the stock market is in a prolonged period of increasing stock prices. The bull and the bear market are opposites of each other. So when you hear bear, then you should associate it with falling prices, and when you hear the bull market, then you should associate that with rising stock prices. Many people say it's good to buy from the bear market and sell on the bull market. And what they mean by that is buy low and sell high so that you make profits. Now, there are 3 terms that I want to cover today that are associated with the actual process of trading. These terms in a way show the relationship between a company and its stockholders. First, let's start off with the stock portfolio. A portfolio is the collection of stocks that you invest in with the hopes of making a profit. Your stock portfolio builds every time you make a trade because it records transactions from all previous trades. By putting together a diverse portfolio that spans various sectors, you're able to become a more resilient trader. Here's an example of a stock portfolio. Next is an annual report, which is basically a report that's prepared by a company in order to impress its shareholders. It provides information about a company's financial status, from its cash flows to its management strategies. When you look at a company's annual report, you're basically judging its financial status, and with this you can evaluate whether or not you want to proceed with making the trade of that company's stocks. Finally, dividends are when companies distribute the extra profits they make. It's a portion of a company's earnings that's paid to its stockholders. When companies make extra profits, they can choose to distribute these profits, and that's known as dividends. A stockholder's equity is whatever a stockholder owns as assets from trading, which includes dividends. Alright, now on to the important part. All parts of this video are important, but this part specifically talks about where trading occurs, and that's through brokerage firms. Brokerage firms are companies that function as liaisons. They buy and sell stocks, bonds, options, and other financial products on behalf of their clients. These are financial institutions that handle assets. Now, there are 3 different types of brokerage firms that traders can choose from, and it all depends on how much money you're willing to spend and how much assistance you need. First, let's start off with the most expensive one. A full-service brokerage provides a professional financial advisor who manages all investment decisions and provides ongoing advice and support. As I mentioned before, this option is rather expensive because a full-service broker or brokerage firm provides you with all the best decisions you can make in the stock market so that you can maximize profits. These are for amateurs who have just started out in the stock market and those who need a lot of assistance. Next are discount brokers, or brokers that allow traders to make their own trading decisions for lower commissions. These are for people who don't need as much guidance in the stock market and are capable of making wise decisions. Finally, there are automated investment advisory platforms that traders can use, which are also known as robo-advisors. They are relatively new forms of digital financial advisors that offer investment management services carried out by algorithms with minimal human intervention at a very low cost, which is why people lean towards these. Now, another thing you should know is the Big Four. The Big Four are the 4 major brokerage firms that are in America, which include Charles Schwab. I've included a picture of Charles Schwab right here, Fidelity Investments, E-Trade, and TD Ameritrade. There are also online brokerages that you can use, and 2 examples of online brokerages are Robinhood and Webull. The last part of this video is probably going to be the most important out of all parts because now we're going to cover how trading works. Of course, these terms show the very basics of how trading happens, but first we're going to start off with the terms bid and ask. The term bid and ask, also known as bid and offer, refers to a 2-way price quotation that indicates the best potential price at which a security can be bought and sold at any given point in time. Starting off with the term bid, a bid represents the maximum price the buyer is willing to pay for a share of a stock of a company. To make it simpler, think of bidding as bidding at an auction for a painting piece. This scenario can be applied to the stock market, but instead of paintings, you have stocks. Going on, the term ask represents the minimum price that a seller is willing to take for that same share of that security. The asking price can be treated as the expectations the seller has for that share. Once the buyer and seller has agreed on a common share price, the buyer can officially buy that stock. The term close, moving on, simply refers to the time at which a stock exchange closes to trading. For example, the NYSE and NASDAQ start at 9:30 a.m. and close at 4 p.m. Eastern timing, with after hours of trading continuing until 8 p.m. Close can also signify the end of a trade after bid and ask prices have been set. When an order to buy or sell has been completed, you can call that an execution. It basically represents the completed transaction of the trade. Apart from ask, bid, close, and execution, another thing you should look for are stock symbols while trading. A stock symbol shows a 1 to 4 traded characteristic alphabetic root that represents a publicly traded company on the stock market. Apple, for example, goes by AAPL on the stock market, while Microsoft goes by MSFT. The final term we're going to cover today is volatility. Volatility in the stock market shows the price movements in which the stock market as a whole moves by. It represents the fluctuation that occurs and is charted by stock indexes. I kept mentioning volatility in previous videos in the past, but I've never explained what it meant in regards to the stock market, so hopefully this explanation clarifies any doubt you guys might have. Unfortunately, time has run out for today. As always, thank you for watching. Be sure to like, comment, share, and subscribe to my channel Stocks for Teens. Spoilers as always, our next video is going to be super important because we're going to be covering risk management. In my opinion, my next video is going to be one of the most important videos I make because it covers common mistakes that people make while trading and investing in the stock market. So in order to avoid that, check out my next video. As always, if you have any questions or content that you would like me to cover in my videos, then be sure to leave a comment down below. But if not, see you next time.